Okay. Welcome back, everybody. I hope you had a good break. We are almost there, but we have one more important discussion that we are going to get through here before the actual closing ceremony. The title for this discussion is A Sustainable and Resilient Future, which is a sufficiently broad title to encompass pretty much everything, everywhere, all at the same time. Now, we're not going to be able, in the space of an hour, even with our esteemed panel, to cover that much ground. But what we will be able to do is, I think, tie the discussions of the last 2 days together, really. Because the red thread that has flowed through everything is the need for sustainability, the need for resilience, which has graduated from being a CSR, NGO type conversation to a conversation that now sits increasingly at the center of economy, business, and policy. It is what needs to be gotten right, and I feel like it is fitting that we're ending the discussion with a bit of a big picture look at what a sustainable and resilient future looks like. And we're going to hear from our panel about some of the work that's being done in that respect, on which note, allow me to very quickly introduce my fellow speakers. To my left, to my immediate left, is Natalie Campbell. She's the Chief Executive Officer of Belu Water. And you might have noticed, or if you're wondering what Belu Water is, have a look at the blue cap bottle on your table. So thank Natalie, as I have done, for the water over the last couple of days. It's been great. Thanks a lot. Next to her is Rhian Marie Thomas, who is the Chief Executive Officer of the Green Finance Institute. And we also have Rahul Ghosh, who is Managing Director for Sustainable Finance at Moody's Investor Services. Okay, to lend a bit of structure to this conversation, we have three main talking points that I kind of want to just go through in turn, and let's try and make this as conversational as possible. And what I'll do is maybe just put these three focus areas out there, and then bounce it off of you and see where the conversation takes us. Before we head into that element, though, a minute or two from each of you just to help us set the scene, a little bit more context about your work, how it relates to the topic and the discussion here today, and if you, off the bat, have any sort of key messages that you want to put out there, you are more than welcome to do so as well. Natalie, over to you.
Thank you very much, and thank you, everyone. It's wonderful to be here. Context for me. So I am co-CEO of Belu Water. The most important thing that you should know about Belu is that we are a private company, we have investors, but we give 100% of our net profits away. We give those profits to WaterAid. We give them unrestricted funding so they can do whatever it is that they need to do to deliver their mission. What we also do is invest in climate resilience activity in the UK. And we made a shift to that work about 2 years ago, and we used the budget that we were spending on offsets once we realized that offsets were probably not particularly useful. And we wanted to build a program of nature-based solutions that we could see, that we could engage with, that we could build a more dynamic relationship with the NGOs here doing the work so that we could further the insights that other businesses need to make the transition from offset into nature-based solutions. And the final thing that I should say, and possibly the most important thing, is that I'm also standing as an independent candidate for the Mayor of London. And what's important about that in relation to this conversation is when we're thinking about resilience and sustainability, what does it mean for a city? And what does it mean when you're thinking about the partnerships that a city needs to build with business, with wider industry, with the charitable sector, with the public sector? How do we do it well, and how do we create new systems? Because the future world that we all want will not be delivered based on the systems we currently have.
New systems, that's, I think, an important takeaway from that. Also, and I'm sure this isn't the first time you've heard this question, but why do you give all your profit away?
Great question. So the founder of Belu was frustrated by the fact that we were drinking imported water in the UK. And one of the things that he baked in, and this was 20 years ago, was that Belu must always do something good with its profits. The CEO that actually then put this in place wanted to do something that went beyond 1%, that went beyond the sorts of things businesses do as a nice to have. It had to be core to our business model. And I don't want to take away from the conversation we might have around ESG, but for us, the G goes first. So within our governance, within the model, within the thing, the way we operate, that purpose comes first. And anything less than 100% means that there's space to deviate from the mission. There's space to think, well, how do we possibly make more money and do less on this side? When if the reason I have my job is to deliver 100% of net profits to WaterAid, my decision-making process is very different.
Okay, all right. Well done. That's serious commitment. Rhian.
I'd say well done is an understatement. That was really inspiring.
Yeah, I was going to say, I feel like that deserves a little bit of recognition, right? Okay, there we go.
Natalie, what a pleasure to meet you. Thank you so much for inviting me here this afternoon. A bit of context for the Green Finance Institute. We're 4.5 years old. We are a London-based organisation. We are currently philanthropically funded. But we're about 60. Most of us are former bankers. And why that's important is we've played quite an important role in the ecosystem of turning targets and commitments that are being increasingly made not just by the financial sector but by governments as well into actual capital mobilization towards the local projects and the local systems change that we need to see, not just in infrastructure, but as Natalie mentioned, nature-based solutions is a major work stream of ours. So how do we do that? We were initially seed funded by the UK government, so we have proximity to the government, but we're set up independently. But that convening power enables us to bring together coalitions of genuine experts from the policymakers, industry, financial services to work on the complex multi-stakeholder, multi-year projects that we need in order to make sure that we've got the right incentives in place, the right enabling policies, but importantly, the right financial mechanisms and institutional architecture. And that's a sort of jargony word for how do you actually pull the right people into the room, make sure that they wake up every day thinking, I really need to find ways of getting more capital towards the things that we actually need to see getting funded so that we actually have a climate resilient and nature positive future. So prior to doing this, I spent 20 years in investment banking. I currently sit on the World Wildlife Funds as one of their trustees. I used to be on the Task Force for Climate-Related Financial Disclosure, TCFD, which I hope rings a bell with most in the room. And I recently played a role launching the TNFD, so the Task Force on Nature-Related Financial Disclosure, which is obviously a sort of sister project to TCFD, which I'd be delighted if anyone's got further questions on that to elaborate. Thanks.
Thank you, Rhian. Rahul.
Okay, thank you very much, and a pleasure to be here. So I work for Moody's. Hopefully many of you have heard about our organisation. We're a credit rating agency. I am a reformed credit rating analyst. So I used to be a sovereign credit rating analyst. For the past 10 years or so, I have been helping us bring clarity to ESG, and in particular how environmental, social and governance issues can impact credit risk and can impact credit markets. So when we think about transition, the transition to a low carbon economy, we've talked about it. We're talking about huge technological disruption and innovation that needs to be financed. It needs to be financed with significant execution risk, with implementation risk. When we talk about adaptation, again, there's a huge challenge to measure that risk and then also plan for the future, to finance the sorts of resilience projects that are needed. When you think about social issues, tightening government policy towards the food and beverage sector, for instance, that's going to have a major implication for the business model of F&B companies, for instance. So there are all of these different dynamics that are taking place, and I'm part of a team within Moody's that is trying to make sense of this all and really to support our ratings analysts so that we can appropriately capture those risks and opportunities and factor that into our analysis. And I would say my major message that I'm going to talk about today is the need to bring some clarity and some order to how we think about some of these huge trends that are taking place in the market. Just to give one example, Rhian mentioned the sort of swathe of commitments that we've seen across the globe. I think depending on the stats you look at, 90% plus of GDP is covered by some form of net zero commitment. But actually peeling those commitments back and looking under the hood and what do they mean and different baselines and different metrics and different assumptions is incredibly challenging and frankly very confusing today. And so really where we see our role as a financial services company is how can we bring some clarity and consistency to help the market really digest and understand these various commitments and then make informed decisions about where they want to put their capital. So maybe I'll go into a bit more detail on that on the panel.
Maybe uncover some greenwashing in the process?
Very happy to.
All right, well, thanks so much. As you can tell, we have a qualified panel when it comes to the topic of sustainability, resilience, and how to presumably work towards a future characterized by those two qualities. Now, let's start with the first sort of main thematic question that we've been given, that we've been challenged to address. And I'll just throw it out there, and whoever wants to pick it up, run with it. In what ways can businesses, financial institutions, and environmental organizations collaborate to create synergies and drive collective action towards a sustainable and resilient future? Very simple, very small question. Anyone? Any takers?
I'm happy to leap in on that one.
As a starting point.
I'll start for 10. We hear all the time that radical collaboration is the only way that we are going to solve for the climate crisis and create this future that you've helped articulate. It's through knowledge sharing. There is no playbook. The world has never been through a net zero carbon revolution before, so there is no monopoly of wisdom how we do this, and it's going to require collaboration in a way we've never seen before, not just between business FIs and environmental organizations, but the scientists and the policymakers. And so we need to find the right fora for that kind of knowledge sharing and that kind of just genuinely influencing one another about how we take things forward. That's a very stratospheric answer. I wanted to give some real examples of where we've seen some of this work, some of them examples of what we're doing at the GFI, but other examples that I recently came across, Walmart, for example, a huge supermarket chain with an immense supply chain, global supply chain, working with HSBC and working with CDP, formerly the Carbon Disclosure Project, to provide preferential trade terms to its suppliers if they disclose through the CDP. So a very practical example. An example that I'm sure will be close to your heart is the Investment Readiness Fund that we at the Green Finance Institute have established with the Westminster government, also up in Scotland, where we're providing grants to the many environmental NGOs who have huge amounts of intellectual capital in the space of nature-based solutions, but very little experience of trying to create business cases and working with investors. So we've got 150 companies at the moment going through those two investment readiness funds. We monitor and evaluate their journey. We collect all that data, we publish that data so that we're creating a community of practice so that people who are looking to do rewilding projects or doing anything where they could potentially monetize their work through biodiversity credits or carbon credits, etc., can learn from others. A fantastic example of knowledge sharing to actually genuinely get capital where we need it to be to help those projects. And I've got a few other examples, but the key point I'd like to make is sometimes, and you said it at the outset, we look at the climate resilient future and it seems such an enormous task. It's quite difficult to figure out how you reduce that to component parts. And it feels a little micro on occasions to say, well, let's test, pilot, demonstrate, scale. Why don't we just go to scale straight away? My point as a financier is money moves between two counterparties, always. We've never found a better way of actually doing financial transactions. And so there is real value in actually finding out what works and designing it for scale. But actually, that is how we're going to move beyond high-level commitments, long-term targets, and actually get money moving where it needs to go.
If I can jump in on that point, the thing that, for me, that underpins everything that you said there, the examples, but also radical collaboration and what enables collaboration to work is trust.
100%.
If anyone has seen the Edelman Trust Barometer, they've got a focus on climate this year, and it's some work they're taking to COP28. And they were looking at all of the elements of distrust between institutions, between countries, that means that we can't move forward on some of this work. And at Belu, the thing that we do with all of our NGOs, all of our partners, is say, this is going to be a trust-based relationship. So we're not even going to think about risk. What we're going to do is say, we trust you to do your work well. We trust that you have built a brilliant strategy, and all you need to do is execute on that strategy if we invest in you. So we won't suddenly jump up and say, we need a report on X, or we need to go to our investors and tell them, you know, what you did. We just trust that you're going to get on with that work, and we will visually come and see what is happening over time. And starting our relationship in that way means they are far more transparent, and we can have a much better dialogue about the frameworks they create and whether or not those frameworks can actually be scaled, or whether or not they have the right partners and stakeholders around the table at the outset. And for me, you don't really even then need to get to that place of radical collaboration, because you've just got the basis of a good relationship. And you know, you apply trust to any good relationship, whether that's with a partner or your children or your best friend or your business partner. You know, you can make decisions easily and know that the other person is going to deliver on their part of the deal because you have that trust.
Those two concepts of trust and radical collaboration, I think what goes hand in hand with them is, you know, recognizing that the economic system we live in, the social system we live in, is just so deeply interconnected. And so, you know, when you think about the implications, for instance, of power companies and the deep system change that we're seeing with electrification, the economics now make sense. We're seeing huge renewables build out. That's going to enable electrification across many, many other industries. And so being able to sort of think about how these pieces come together and trust in others to also collaborate is important. On the collaboration point, I'd also say, having been in the sustainable finance industry for around 10 years, I think there is a good spirit of collaboration. We do need to be mindful about the number of initiatives that are being created. I would say pick the ones that are really going to have impact. TCFD that Rhian mentioned is a great case in point. Education, right? So something that we're really focused on is articulating to the market that environmental, social governance issues can impact your bottom line, can impact your credit quality. So if I look at around 11,000 companies and governments and financial institutions that Moody's rates globally, around 1 in 4 of them, ESG is having a material impact on their credit rating. For around 20%, so 1 in 5, the credit rating of that issuer would be higher if it were not for an exposure from ESG that we don't think is being mitigated or managed. So these things matter for the cost of capital and to access to capital. And the more we can educate the market that, yes, doing good is incredibly important, but actually this is about good business as well, I think is really important. And then the final point I'll make, it's a well-versed one, but we all should be hugely supportive of consistent disclosure, right, in this space. And the sort of alphabet soup of disclosure standards, the ingredients are starting to narrow, which are good. We've seen TCFD come under the jurisdiction of the International Sustainability Standards Board and other disclosure setters in there as well. Why does that matter, right? We talk about disclosure a lot. As a analytics firm, today we're very reliant on third-party data. We're very reliant on voluntary disclosure where we can find it to provide insight to asset managers and asset owners. A lot of time that means big assumptions, modeling, which has its flaws, proxy data, coverage is patchy, and that limits the insight that we can provide to the market, and it limits the impact that investors can have with their capital. So the more that we can get towards a global baseline, and we've seen a lot of encouraging steps, and I've been privileged to be a member of TNFD that Rhian was a pioneer of, the more we can get towards a consistent set of disclosure to inform decision making, the better the work that the likes of Moody's and others will do. And I think the more powerful the opportunity for investors to allocate their capital to projects, assets, activities that will really have a genuine real-world impact.
I'd like to be a bit provocative on the disclosure bit, just to open it up. Our approach at Belu is open source. With disclosure, there's an element of choice. If I have an open source business, every element of my business is absolutely open. So our way of demonstrating this is our purpose P&L. We share on an annual basis an impact report that includes a purpose P&L which outlines every single metric within our business, financial right through to what we're investing in learning and development, and we track our progress against these metrics and we share that information. We then make it really clear our net profit position, so someone can't say, and we take our audited accounts, have a look. So people can't say, well, that's not necessarily your net. No, it is. It's right here. This is where it went. This is what we spent on nature-based solutions and investments. This is, the list goes on and on. It's then aligned to the Sustainable Development Goals, so Sustainable Development Goals 6, 12, and 13. Those goals are also in our articles, so I removed shareholder primacy as our primary object, and I made Sustainable Development Goals 6, 12, and 13 our primary objects again. Change is what I'm performance managed on. And because we take that open source approach and then say to any business, you can use this. The way that we interact with our customers and our supply chain is very different. We have CFOs that would challenge another brand on margin that won't necessarily challenge us. And anyone that's watching at home, don't try and challenge me on the margin now, wherever the live stream is. Because they can see that we need margin for mission. If we reduce our margin right down to 1%, there is no money to go to WaterAid. There is no money to invest in the nature-based solutions. So that level of, I don't even like the word transparency. Open source is the only way I can describe it. That creates a very different trust-based relationship.
And does that allow you to sort of sidestep the web of questionnaires and surveys and things like that as well? Which, is a challenge in terms of creating administrative burden on companies.
Yeah. So some people still need policies, but generally, yes. And to your point around greenwashing, again, touch wood, it doesn't come our way because I can say, here's the data. And it's not complicated. It's, there's no jazz hands here. It's really simple. You can track from revenue to what we spent against the SDGs to what was left, and it's that.
I hope you don't mind me saying this, but Belu sounds like it's the exception to the norm in the approach. That's not a criticism by any stretch of the imagination, but I wonder, to what extent is it important to have, for lack of a better term, just leadership like that in the sphere of running a commercial business? Because I imagine in conversations you have with with industry peers and in general, there must be a lot of confusion when you describe how the company operates. But do you find that there's also an opportunity in that to perhaps, I guess, educate or compel, the right, the right way of doing things, frankly?
So when people say it's not possible, I sort of go, oh, really? And I either give them an example of what we've done. And, we're a small business. We're 8.5 million turnover business. In a good year, that's £1 million going to WaterAid in net profit. We're B2B only. Thank you. We don't sell into retail, so we're B2B only. If we were in retail, revenues would be huge, but we made an environmental decision not to be in retail. Again, odd, because most people would just go for growth. But I want to highlight our investors in this. So our primary investors and owners are Sir Chris Hon, and Sir Gordon Roddick. Sir Gordon Roddick, the husband of Dame Anita Roddick, an environmentalist through and through. Sir Chris Hon, an activist investor, will be at COP having that conversation around disclosures. If we can convince those two individuals that this is the right way to do it and this is what I should be performance managed against, then it's possible to do this at scale. There needs to be leadership will. You need to make a choice, and you have to take your investors and therefore the market on the journey of why is this a good thing to do. And I don't expect every single business to do this, because not every business was set up to do this, but Belu was. And so for me to do anything other means that our brand promise just doesn't work.
Mm-hmm. Mm-hmm. That's going beyond pledges.
Yeah.
And platitudes in many ways. Any more thoughts on this first round?
I was just going to say it's a fantastic example of test, demonstrate, and scale, right?
Yeah.
It's that by putting that example out there, by actually, as you say, doing everything open source. My good friend Andrew Winston wrote an article in Harvard Business Review recently, and he just said to all leaders out there who feel they can sit on the sidelines of this agenda, there are no sidelines. It is so transparent. If this isn't something that you are engaging in as a private business, you are going to lose your social license to operate. And that is what is at the heart of it. Despite the plethora of metrics, and I love the way you described it as the web of questionnaires, that is, over time, that will align. I don't think anybody is taking a position at the moment that they think this isn't all going in. There is a clear trajectory, one direction that this is headed. Anyone that thinks this is a fad or that it's all just a passing fantasy and then we'll all go back to doing things the way we used to do them without taking into consideration climate and nature risk in financial decision making, they are not going to weather the storm. Yeah. And having fantastic examples of, an £8.5 million business managing to operate the way you do is a perfect example for other organisations too. Good luck.
Thank you.
On the topic of scale, we've touched on that a couple of times. And this is our second main discussion point. How can sustainability initiatives, such as those related to clean water access, natural capital investments, and green financing, be scaled up to address global challenges effectively? The question of scale is fundamental. Rhian, you made the observation earlier that the problem itself, the challenge itself, feels so overwhelming because it just encompasses everything. It feels like no amount of scale will ever be enough. But you made an interesting observation, I think, in saying that, well, don't dismiss doing things on a small scale. Don't dismiss the micro in this discussion. When it comes to scaling up, where would you weigh in on that conversation?
So when we say sustainability initiatives, I always look at everything through, as a financier, through financial lens. So, when you're a hammer, everything looks like a nail. So how do we scale up sustainability initiatives that are designed to mobilize more capital? And sadly, there's no green bullet that can fix all this. And so it's quite a long list, but it's like, for one thing, we need adequate pricing of climate risk. We need innovative financing instruments. We need to broaden the investor base. We need to expand the involvement, the role and risk appetite of multilateral development banks and development finance institutions. We need to strengthen climate information, and you touched on it, Rahul, climate data, disclosure standards, taxonomies. And importantly, we need to find those innovative financing mechanisms that are designed to reduce risk so that the commercial financial institutions can actually play a greater role. At the moment, we are in a situation where, provided it's illegal, it is still legal to make money from high carbon emitting, nature depleting transactions. The financial sector is like any other industry. It has honed itself into efficiency. So those transactions have lower friction costs. The organizations have been set up to do some of these transactions and make a lot of money from them for their organizations and for their employees and for their shareholders. But now that we know better, we should do better. But turning the tap off on some of those transactions for unfamiliar, first-of-their-kind technologies in jurisdictions where perhaps you don't understand the risks and you perceive the risks to be greater. This is where we need to help de-risk those particular first-of-their-kind transactions. And this is where concessionary finance, the role of philanthropists, and you mentioned two of them and the fantastic work that they're doing, the role of venture philanthropy, the role of the multinational development banks, government balance sheets. We need far more of this money being used as equity, being used as first loss, and taking the riskiest part of a transaction so that the financial institutions can familiarize themselves with these investment opportunities. The numbers of finance that we need to get into particularly emerging markets and developing economies is in the trillions annually in order to transform our energy systems, make sure that we are investing in adaptation and in nature-based solutions. But the capital markets are deep and are full of ingenious and creative people. We can do this. I really do feel as we go to COP next week, the Conference of Parties, the UN meeting in Dubai, so many of the policies are in place, the technologies are in place, the financial awareness is in place. It's almost like this is the end of the beginning. I don't want to say it's the beginning of the end because that sounds very wrong, but it's the second part. You know, what does 2.0 look like for this? It probably means less focus on the plethora of disclosures and all the rest of it, and more innovation, more creativity, but importantly, more scale to get capital where we need it to go. We have the answers. We do need stronger leadership to get there. And I'm genuinely optimistic and quite excited about where this takes the financial markets over the next few years.
Yeah, very well said. I'd add one point to that on the capital flow. I mean, EM domestic financial assets are not insignificant. In fact, you know, when you look at pension fund assets within emerging markets, there's huge untapped assets that can support that sustainable infrastructure need in emerging markets, and whose owners understand those risks better than anyone as well. So I think it's, it's the diversification of investment that we need as well. I wanted to, you mentioned your question, nature-related investments in particular, so I wanted to just touch on that quickly. Obviously, working at Moody's, I'm particularly focused on the debt markets, and undoubtedly the most dominant trend of the debt capital markets over the last 10 years has been the growth of sustainable debt, right? Labeled bonds, green, social sustainability bonds. It's been a huge story, right? We're looking at around $1 trillion of issuance globally this year. That's from 10, 20 billion just 7, 8 years ago. But if we look at where those proceeds are being channeled, today it still remains largely a climate change mitigation story, right? A decarbonization story. So when I look at funds going into renewable energy, clean transportation, energy efficiency, all to decarbonize our economy, that's around 50 to 60% of all proceeds from this $1 trillion market. When I look at life on land and life below water, you're talking about 5% and 3% respectively. So still very, very small shares. Why is this the case? I think there are many reasons, but one is it is still difficult to find bankable projects at the scale that's needed for a benchmark-sized bond, particularly in some of those markets that are most vulnerable. So I think in the short term, we're going to really have to rely and push on public sector issuers to finance nature and biodiversity-related projects. Clearly, that comes under the mandate of any government, right, protecting nature, but also looking at the connectivity again. It's a word I'll come back to between your climate policies and your nature policies, right? Adaptation, resilience, and nature and mitigation are deeply interconnected. I think there's also, like we've seen with climate change, the opportunity to use sustainable bonds as a government to reinforce your commitments to global policy pledges, like the 30 by 30, so protecting 30% of nature by 2030, that was agreed last year as part of the Kunming-Montreal Global Biodiversity Framework. How better to really reinforce your commitment to that than hardwire that into a debt transaction. We've seen a little bit of this so far. We worked with Egypt last year ahead of COP. They were looking at things like sustainable fishery aquaculture management as part of their sustainable bond. We're seeing tentative signs of the growth of blue bonds. Uruguay issued a sustainability-linked bond, which included some KPIs related to protecting nature. But there's much more to be done there. Whether the private sector follows, I think it will, but it will be a slightly slower burn because of that issue over bankability of projects. But when I look at efforts like the TNFD that we've mentioned, really creating a common language around accounting for nature, investor engagement initiatives around nature, which are starting to flourish, clearer policy targets, I do think more companies are going to start disclosing their nature-related targets and transition plans and incorporating that into their debt capital management strategies as well. And what I'm hopeful for is we see a bit of a Paris Agreement effect. What do I mean by that? When we saw the Paris Agreement in 2015-16, clear policy targets, that then led to company commitments around how they're looking to align with the Paris Agreement, and that was then hardwired into their sustainable debt plans. If we can see a similar sort of effect with nature, taking 30 by 30, creating corporate transition plans, hardwiring that into debt capital market strategies, then hopefully that starts to see an acceleration in the sorts of capital we're seeing towards nature.
Can I pick up on, sorry, Natalie, I'm sure you want to come in, but I'll just pick up on a couple of things you said. One of them is when you look at that trajectory that we've seen with carbon, Paris alignment, then the transition plans, there was another piece that was done, which was the work that was done to make finance and business realise that climate risk was financial risk.
Yeah.
And we need to do that, I think, with nature as well. And I know there's some fantastic work being done by Professor Desgupta and others showing about how the economy is reliant at a macro level on nature. But some of the work that we're currently doing with the Bank of England in the universities of Oxford and Reading is actually looking at where nature risk is going to start manifesting itself initially in the UK market and how that will transmit itself into financial services. And that's a piece of work that we would be very keen to replicate in other markets. It's a methodology. It's not a simple methodology because obviously the forward-looking scenarios are very difficult, but I do think that that's a really key component in making people realise at the board level that this is something that is the business of business and needs to be taken forward. And then the second point you made, which was an excellent one, thank you, Rahul, was reminding us that there are deep pools of capital in local markets. This isn't a story of just how do we channel money purely from the global north to the global south. It's actually how do we come up with the constructs to make sure that local domestic capital is able to invest in infrastructure and nature in those local markets and the importance of that. So a quick story, if I may. We have an office in Cape Town in South Africa. We've been working with the local banks there on blended finance, so that mix of public concessional capital to crowd in private capital. And I remember in the first sort of thinking that we had to look at how we could do this, a number of them said, what we really, really don't want you just to flood our market with cheap money coming out of London. What we actually want is to enable us as banks to write the check on day one, to underwrite climate smart infrastructure projects, and then we can then offload our risk to the institutional investors, the pension funds, etc., that sit in the South African market. It's a sophisticated finance market with deep capital market. And we said, fine, we can help you do that. We can help write a guarantee that will guarantee half your debt, so that the way that would then work in a banking model is that you could provide better pricing, because you're really only taking half the risk you thought you were taking before, because the other half is guaranteed. And that would enable them to do more deals and enable them to on-sell that risk to institutional investors who otherwise would be investing in government securities. And while we were structuring this transaction, the phone kept ringing, with banks ringing us up saying, we've got a deal we'd like to do. When's your guarantee coming? So we tripped over £1 billion worth of climate-ready infrastructure projects in South Africa, shovel-ready climate-smart infrastructure projects in South Africa. But for want of the concessional finance piece at the bottom, we still haven't been able to bring it to financial close. But we are working on it with partners, with banks. It is a fantastic potential solution to actually find ways of crowding in and leveraging capital to go to those projects. So when people say to me there aren't bankable projects, I say that isn't entirely our experience. There are projects that need a little bit of assistance in order to get into that bankability window.
And you know, whenever I talk about credit ratings, I've got to be mindful not to bore the audience. But it's an important point because some of those precedent transactions that have first loss guarantee or political risk insurance that we've looked at, you may end up, because of that credit enhancement, having a credit rating that in some instances can be higher than the sovereign in that country. And that is a huge enabler to crowd in that sort of investment that you're talking about. Really.
And I'd like to thank Moody's because you did some of the actual modelling for us very kindly pro bono at the time. So, anyway, opportunity to thank you publicly.
Natalie, did you want to comment?
Yes, so actually you're both inspiring me. So I'm going to switch hats into the mayoral one for a moment. And I'm thinking on the fly here, but what's stopping a metro city mayor saying, I now have a new revenue stream of £600 million from ULEZ, from a tax that's about the environment. How can I leverage that 600 million in some of the ways that you've mentioned? How can I use it to invest in smaller scale pilot projects that can be replicated across the capital, but also used for all of the other cities with a similar infrastructure? And what we're going to do with that 600 million, which at the moment people don't know where it's going, we're going to focus on the life essentials. So we're going to focus on water, because there's a big old thing just out there. And London is a city of rivers, most of which I think support a sewage system. I'm going to think about food security. I'm going to think about energy. And we'll do these projects with a view that we can take them to scale and leverage in private investment, get these projects underwritten for the long term so that London does become a beacon of climate resilience and a sustainable future, given all of the levers that we have at our disposal in this capital. And that, for me, feels like a much better way to use £600 million a year.
So may I leap in on that? I know you posed it as a rhetorical question, but the answer I have is the London Future Finance Fund, which we've actually structured for the current Mayor of London, and which we'd be delighted to do in other municipalities, to your question. And we're still talking scale here, so we'd love to do it elsewhere. And basically what that's done is we looked at how this has been done in different cities. And in London, we pooled the resources of a number of different boroughs, many of whom have declared a climate emergency, so that you have a central pool. The Greater London Authority has hired a team of 2 very experienced, very capable people who are now overseeing the use of that fund. It's got a little bit of central government money in it as well. At the moment, it's primarily focusing on projects like retrofitting and others that the boroughs can actually apply for. But in the same way you would do in the private sector, by creating a portfolio of well-invested climate opportunities, we should then be able to go to the private investment community and say, okay, now we want to lever this fund. So that 500 million, which is the size that it currently is, would get to be a lot bigger. So we sit on the credit committee, one of my team advises from a finance perspective, you know, about what are the good projects to go into this portfolio, and we're really excited about it. So more to be discussed later, but you're quite right. You know, there are a number of ways of using, smarter ways of using financial revenue streams so that you can actually start attracting private investment. That's the key.
We have
Sorry.
just 11 minutes left. I'm sorry to
You've not asked any
interrupt.
questions, have you?
Pardon me. It's great when the conversation flows like this, but we only have 11 minutes left. And I want to switch the focus a little bit to the question around priorities and opportunities. So we're heading into the Commonwealth's Heads of Government meeting next year. I think I will throw in there, we're also heading into COP28 next week. Big gatherings, big events, these are big markers in the calendar year around which a lot of conversations regarding sustainability and resilience take place. What are some of the biggest or most critical priorities and opportunities as we move in towards a more sustainable and resilient future?
Can I throw one in straight away because it's relevant, because it's sitting right there and in other vessels on the table? Water. I went to a water aid dinner last night called Water Can't Wait. And when we think about water as a life essential, that then enables health, food security, education, poverty reduction, and. I was ridiculously surprised to learn that it's only the second year that it's been on the agenda for COP28. And it was only last year where there was some significant convening around it. And so I know that the base conversation or the starting conversation for COP was around decarbonisation, but it seems ludicrous to me that someone in that pool didn't say, what about some other things like water? So if we could start a meaningful conversation about water as a resource, and there are other things, but without water, literally, no one in this room would last more than 24 hours without it. I think we can get some gains on the wider climate discussion, because for some people, I think the net zero conversation, decarbonisation, feels like a mighty hurdle, and I do believe water, we can tackle some things quite quickly and get some significant gains to build the trust, to build the collaboration, to think about financing in a different way.
You know, I had my doubts about the COP process. You've just kind of vindicated and validated those doubts. That's frankly bizarre. Anyway, sorry, Rhian.
Well, it's very difficult to argue against the water point, so I think that does need to be a priority. Unsurprisingly, I'm seeing one of the priorities is money. And to the point about the COP, it was COP25 was the first COP that was a convening of the finance ministers. This wasn't viewed as a finance issue initially. This was viewed as an environmental issue, scientific issue, policy issue. It is a financial issue because without finding ways of allocating finance to many of these initiatives and to many of these challenges, we are talking aspiration. We're not actually talking objective outcome plans. So for me, absolute critical priority and opportunity, and I must say, I love the way you framed the questions. They're so positive. It's about opportunity. It's not just about risk.
I didn't write them, so I'm not going to take the credit. Whoever wrote them.
Whoever wrote them, you did a great job.
Credit
Thank you
is
so
yours.
much. But so to me, the absolute critical priority is finding ways to actually create the right sort of institutions that can actually mobilize capital. When we talk about blended finance, when we talk about private sector collaborating with the public sector, where is that going to happen? Which institutions are we setting up such that those conversations are more than conversations? They are actual projects and initiatives that drive to deliverables and drive to outcomes. Yeah.
So I'm a risk analyst, Rhian, so I've got to really fight with that glass half empty mindset that's drilled into me. I'm going to say a focus area has to be on execution. So I'm going to say something that I hope isn't controversial, but just having a net zero target or pledge doesn't mean that you're going to be a better credit risk. It doesn't mean that you're going to have better opportunities going forward. It is all about the implementation, right? And I'll share a story. I met with the chair and the CFO of a global commodities company. I won't tell you the country because that will probably give it away. And it was a really enlightening conversation, right? The chairman was telling me, look, over the last 10, 15 years, I have built my business on exporting commodities to China. Right? That has been the single strategy that we've had. If I take that and I put that forward for the next 10, 15 years, I don't think I'm going to be in business. I need to think about how can I sort of steer this giant of a company into mining the materials that are needed for the future, for green technologies. How do I invest in clean tech, in hydrogen and ammonia? How do I build the technological capacity I need, the human resources, the equipment to enable me to do that? That's going to take a huge amount of financing. The way I can finance that is being ambitious but transparent and credible to my investors, explaining what I can do right away, what I can't do right away, how I intend to evolve my business over time. And the best way for me to do that is to issue a green bond, and by virtue of doing that, the label isn't really that important. It's the transparency and the accountability that allows me to articulate that story to the market and to the likes of you, credit rating agency, because if I get this wrong and I invest a ton of money in the wrong technologies, that's not going to be good for me either. And so by having that conversation, by talking about the signals and the investment plan and the CapEx plan, it gives investors, it gives analysts that comfort and confidence that that particular company is going to manage that journey effectively. And so I guess my question for the next phase is, whenever you see a net zero pledge or commitment or target, really do take the time to peel back the onion and think, okay, what is the starting point? What is the end point? And crucially, what is the execution plan to get there? And does that look credible? Does that look reasonable? And is it going to be well financed?
So one of the takeaways from a discussion we had yesterday was we need less talking and more walking. And it sounds like that's what you're alluring to, which, again, I can't really argue with. Now, we have 4 minutes left, which means we already have to wrap up the conversation. What I would like to challenge you with is to maybe just give us one or two things that need to happen in the next 3 to 5 years, or like, actually, let me put it differently. Like, how do you see the journey towards a resilient and more sustainable future evolving in the coming years? Like, what do you anticipate? What's the direction of travel here? Because that to me seems like an important issue. And Rhian, just a sec before I throw that over to you. For me, just my 2 cents here, what's been striking is that over the last 2 days, I've listened to a lot of bankers or ex-bankers talk about climate change, sustainability, ESG, resilience, et cetera. That's new to me. Those conversations weren't taking place even a few years ago. Now, I hope that's a good sign that all these bankers are now talking about the environment. And to me, that suggests that there is something underpinning, there's an undercurrent here, something fundamental that seems to be shifting. And perhaps you can factor that into your final thoughts on this. Like, tipping point, I think, is probably getting ahead of ourselves, but are we moving towards something that is irreversible, perhaps?
I think we are, yes. And I think it is a good indication, because the alternative is we are financing ourselves into extinction. And I'm not, that isn't an exaggeration. That is what the climate scientists and the models are telling us. And therefore, this isn't, there's a lot of complexity here, but there is also real simplicity. Scientifically, economically, morally, there is the right thing to do. And those of us that are not on board with this yet need to get on board with it very quickly. So yes, I think it is a good thing, and thank you very much that you've had so many of those conversations over the last 2 days, because that's what's changed too, I think, in many of these conferences. Where do I think things are going to go in the next 3 to 5 years? I think one of the things that we're going to hear an awful lot more about is energy efficiency. Because at the moment, where the models are saying we need 7 times more renewable energy by 2030 to meet some of our targets, it's very, very difficult to do that, to make sure that our grids are fit for purpose, to make sure that planning is done, to make sure the finance is there, that we have enough engineers. And this isn't in the UK, this is globally. But at the moment, 70% of the energy we produce is wasted. It's inefficient. And so that is something that isn't getting quite enough attention. And also there are obvious business cases and advantages from using your energy more efficiently, because you lower your costs. So I do think that is something, and there's some great work being done in a fantastic book recently published by a good friend of mine, Jonathan Maxwell, called The Edge. You're welcome, Jonathan. I do think that makes a very, very compelling case for why energy efficiency needs to be much further in the agenda. So I do think that's something that will get a lot of attention over the next few years.
Right, I'm getting the hand signals that we need to wrap up. So very briefly, apologies, but Rahul and then Natalie, the final word.
Very briefly, you mentioned greenwashing risk earlier. We haven't really talked about that, but while I'm not going to deny that greenwashing exists, I think there's confusion around what it is. Often it's a perceived lack of ambition. And my concern is we go the other way. If we get investors too concerned about taking smart risks, then we're just going to finance wind farms in Sweden, right? Which is a great thing to finance, but it's not going to move the needle on
That's not going to solve
decarbonisation.
climate change.
So we need to unlock, and this is sort of pop back to the point that Rhian mentioned, sustainable debt, sustainable capital markets in emerging markets, in particular EM Asia, which I think holds the key to this whole story. I work in sustainable finance. I've seen tremendous growth this year, but we still need to really figure out what does a transition story mean for Asia. GFANs and others are doing great work in that area, but let's figure out that story and let's get the capital moving.
Great. Natalie?
I'm
the
going
last
to
word.
say brave leadership that understands the importance of building relationships underpinned by trust. Because if we have that, whether that leadership comes from finance or governments or the local activist group here or there, we can start to move forward at a pace that we're only starting to see the beginnings of.
All right. And on that note, I have to bring the session to a close. We're now going to head into the closing ceremony. I would have loved to just let you guys carry on, to be honest. Hugely significant, important, critical topic, important, impossible to overstate. To be continued, no doubt, both in conversation and in action. Thank you so much, Rahul, Rhian, and Natalie, for such an engaging conversation.
Thank you.